Welcome back to the Global Ledger. I'm Justin. This is episode 51, and today we're starting the next phase of the series, Monetary Policy in Practice. And we're going to talk about something that almost nobody outside the plumbing ever focuses on, and that is interest on reserves, or more precisely, interest on reserve balances. This is IORB for short. Because once you understand IORB, something important clicks into place. That is, the Federal Reserve does not control interest rates the way people think it does. And market rates don't float freely either. Instead, modern rates sit on a floor. And that floor is IORB. Let's get into it. Let's start with something basic, but often misunderstood. What reserves actually are. Reserves are not money in the economy. This is a very important distinction to make right at the beginning. Reserves are not money in the economy. They are not a part of the economy at all. Reserves are balances that commercial banks hold at the Federal Reserve and used to settle payments with each other. You and I cannot hold reserves. Corporations can't hold reserves. Only institutions with Fed accounts can. Okay? Reserves are the settlement asset of the banking system, the base layer of the hierarchy of money, okay? They exist inside the system, not outside the system, okay? So this is a really important distinction to understand up front, okay? So let's talk about the old world versus the new world. Okay, we talked about what reserves are, okay, and their parameters. So the old world versus the new world. Before 2008, the Fed controlled short-term rates differently. Reserves were scarce. Banks needed them to settle payments. So banks borrowed reserves from each other. The Fed nudged the supply around. The Fed funds rate moved based on scarcity. This is the textbook story, okay? But after 2008, that world ended, okay? And then we get into the world of the age of abundant reserves, okay? So after the financial crisis, and especially after QE, reserves became abundant, okay? The Fed created a large quantity of reserves by buying treasuries, buying agency MBS, which is mortgage-backed securities, and crediting reserve accounts. Suddenly, banks were swimming in reserves. And here's the key problem. If reserves are abundant, okay, how do you keep interest rates from falling to zero? Think about this. If reserves are abundant, how do you keep interest rates from falling to zero? The old system no longer worked. Okay, so the Fed introduced a new one. So what IORB, interest on reserve balances, actually do? What does it do? Okay, interest on reserves means the Fed pays banks interest on the reserves they hold. Think about what that implies. Okay, if a bank can earn a risk-free rate directly from the Fed just by holding reserves, why would that bank lend those reserves overnight for less? Think about it. Reserves at the Fed are guaranteed. I mean, there is no safer form of money. And so when banks are lending to and from each other, And they can get a risk-free return directly from the ultimate. I should use my words correctly here, but the only institution that can create the best money in the world, and that's the Fed. If they can get a risk-free rate directly from the Fed just by holding reserves, why would that bank lend those reserves overnight for less? It wouldn't. Okay, so this is where interest on reserve balances become the minimum acceptable rate for banks. That is the floor. That is the floor. So this is why what I'm about to say, IORB is the true policy rate. And it's a very subtle and crucial point. Okay, the Fed no longer targets rates by adjusting reserve scarcity. Okay, instead, it administers a rate and lets markets align around it. IORB is not a signal; it's an offer, a standing offer from the central bank that says you can always earn this rate risk-free. That changes everything. Okay, so this is where a lot of confusion comes from. Okay, people still talk about the federal funds rate as if it's the center of the system, or as if it's where policy is transmitted. But in reality, Fed funds is now a thin market, traded mostly by institutions without access to interest on reserve balances. Think about that. Traded mostly by institutions without access to IORB. What are the institutions that only have access to IORB? The only institutions that have access to interest on reserve balances, that risk-free guaranteed rate, are institutions, banks that hold a reserve account at the Fed. Okay? So the Fed funds market is traded mostly by institutions without that access. Okay? But the Fed still announces a target range. But the real anchor behind all of it is interest on reserve balances. So think of the modern rate system as a corridor, okay? And this is how the floor system works. So interest on reserve balances sits near the top of the corridor, okay? And then there's another term I'm going to introduce. We've talked about this before. It's the ONRRP. Okay, that is overnight reverse repurchases. Okay, so let me say that again. It's a mouthful. The abbreviation is ONRRP. That stands for overnight reverse repo purchase agreements. Okay, and this sits at the bottom. Okay, so we have IORB, which is interest on reserve balances, which sits near the top of the corridor. Then we have ONRRP, which is overnight reversed repo purchases, okay, which sits at the bottom. Okay, market rates trade in between these two. Banks will not lend below IORB. Why would they? When they can get a less risky rate, or I should say this, when they can have less risk at the Fed and get a higher rate of return. Okay, so this is important. Money market funds. Okay, so banks won't lend below IORB. Money market funds, and we've talked about them before, okay? They're huge, okay? Money market funds won't lend below ONRRP. Because why? Why would they? Okay, the Fed is guaranteeing them a rate of return. Okay? The Fed controls the edges, not every transaction. Okay? So this is market structure, not command and control. Okay? So that's how the floor system works. Okay? It's a corridor. Why does this matter for markets? Okay, once you understand IORB, several things become clear. Why rate hikes transmit slowly, okay? Why liquidity conditions matter more than announcements. Why banks sometimes don't lend even when rates rise, okay? Why policy feels tight or loose beyond the headline number. IORB affects bank balance sheets, okay? It affects risk appetite. It affects funding cost and ultimately asset prices, but indirectly, always indirectly, okay? So let's clear some things up, okay? Some common misconceptions. IORB does not mean the Fed is paying banks not to lend. Okay, very important here. IORB does not mean the Fed is paying banks not to lend. It does not mean money is being printed. Okay, and it does not mean the Fed controls inflation directly. What it means is the Fed sets the terms under which banks choose to deploy balance sheets. And that's a very different thing. And I'll repeat that one more time. What it means is the Fed sets the terms under which banks choose to deploy their balance sheets. Okay? Very important, because we always want to think in balance sheets as much as we can. Where does all this fit in the bigger framework? Okay? This episode sets the tone for the entire next arc. Because once you see how the floor system works, how rates are administered, how balance sheets respond, you can better understand QE versus QT, standing facilities, discount window stigma, financial conditions, and the limits of monetary policy, which is exactly where we're going next. In the next episode, we'll tackle something closely related and widely misunderstood. And that is why the Fed funds rate isn't what you think it is anymore. Because in the modern system, the most important rates are often the least discussed. I want to thank you for listening to episode 51 of the Global Ledger. And now that you know where the floor is, we can start building upward. Once again, I'm Justin, and thanks for being here.